Welcome to the last session of the day before closing remarks. So we have two big fintech investors here, two speakers. Aaron, the moderator, is still trying to load the WebEx, so we'll just go ahead. So the first speaker is Hans Morris, who is the partner at Nyca and also founder of Nyca, but he is also a chairman of the board of Lending Club. I have been using your data for my research, and it's the top 10 SSR and download regularly.
Well, we're happy to help in at least that way for your research.
And Han also was previously president of Visa. Just to keep it short, the full bio is in the booklet. And Matt Harris is partner with Bain Capital Ventures, and he's really in charge of fintech there. Besides his role at Bain, he also has been active in sharing his knowledge through interesting articles in Forbes magazine and also being keynote speakers at different fintech conferences. I saw him the first time at the NYU FinTech conference a few years ago when he was a keynote speaker. So very happy to have you both here today. And so hopefully Aaron will join very soon. So for now, I will let you two kick the ball. Go ahead.
Duke it out on our own.
Yes.
Well, why don't I start with a question for Matt, which is COVID changed everything in payments, changed a lot. But one thing that it did is it showed the difficulties of moving money, and that became clear in terms of benefit payments and people, waiting for emergency checks to arrive in the mail. And you've written about, in your view, in 20 years, 19 years, we'll be done with physical money, and we'll just be using digital tokens that won't even be backed by a central bank. That may be a big step, maybe not, but how is that going to happen, and what do you think will explain that transformation?
Well, first of all, thanks to the Federal Reserve for having us here on this self-moderating panel. You've heard of self-driving cars. We're going to have a self-moderating panel. I suspect it will work quite well. It's a privilege, Hans, to be here with you. Yes, well, I will say that when I write about things that are going to happen 19 years in the future, I take vast liberties. It's one of the luxuries of post-dating your analysis that dramatically far. And I'm well aware of the idiosyncrasies and failings of our current payment system. I would say the things that were exposed by COVID to me are more about identity than anything else. There are digital payment rails everywhere and have been, since the 70s. But what you need is, stable, reliable, authenticated accounts, both ends of a payments transaction. And in the case of federal funds disbursement, we have one authenticated account, the federal government, but the recipients, the beneficiaries, it was an incredibly chaotic system. And in fact, it's gratifying that the solution in many cases actually, were developed by fintech companies. In small business lending with the PPP program, it was companies like Cabbage, Lendio, and others who actually made sure that the money got to the right small businesses. And in the case of the government programs that COVID precipitated, it was companies like Propel and others who were able to create accounts, to authenticate accounts, to give unbanked and underbanked consumers the opportunity to avail themselves of these new government programs. So as in many things in fintech and in tech, COVID both exposed things and then actually brought about at least partial solutions in many cases. I personally think identity is going to be a largely solved problem, certainly over the course of the next 2 decades. There are people who don't think that's a good idea, who think identity is a problem that should remain unsolved for the benefit of civil rights and civil liberties. But personally, I think whether we like it or not, biometrics and other advances that are just the benefits of being known, funds receipt being one of them, are stacking up to the point where everyone in America will be verifiably known in 19 years. And so I think by that time, then we will be able to avail ourselves of the benefits of things like stablecoins. Right now, Visa and MasterCard these networks that basically have the benefit of connecting merchants with all these cardholders and therefore enjoy tremendous economic rents as a result, frankly, rents that are small compared to the benefits they deliver. I have no issue with Visa, MasterCard. I think they have moved the ball forward dramatically. But they are the only ones who've sort of brought chaos out of disorder. And I see an advance towards greater orderliness in terms of, again, authentication and identity. And that's going to make payments easy. And that's going to make payments dissolve more in the background and allow for more creativity. So yes, I am optimistic on that score, notwithstanding the challenges that we're still working through. You, of course, were president of Visa. You, before that, had deep experience in the payments ecosystem. Talk a little bit about the progress you've seen, maybe push back on any of my optimism in this regard.
Well, actually, I think I agree with a lot. I guess I want to clarify something that I think you're saying, but maybe confusing. People may misinterpret it, because I think that this issue of a digital token representing identity, I used to think that was a good idea, but far-fetched, hard to distribute, hard to get to it. I actually think that moment has come, because it is, we talked about that idea when I was at Visa even. And so the idea that you could have simply a representation, a completely secure representation of me or you, and use that for all different types of payment types, and then reduce friction in the payment system, I think that actually could become real. And I don't think that necessarily, it might relate to the central bank digital currency, but I don't think it's necessary for it to relate to digital currency. And to me, one of the things that if you look in 10 years, 11 years since I left Visa, I think the changes are just breathtaking, but I also say there's a lot more to go. You can now see where we are. And I think, many types of specialized software for all different types of verticals, all types of business verticals are now incorporating solving payments problems within that specialized software. I think the fact that we're going to have ubiquitous real-time payment systems around the world will change things again, give many, additional set of options for settlement. I think that crypto is now in tens of millions of consumer wallets, and that is yet another settlement option. And I think the other thing that's really quite important is the fact that fintechs have targeted specific groups. It could be businesses or consumers, and people that the financial system would have thought were unprofitable service. And now you can profitably service them either by tinkering with the business model, create revenue streams that weren't available before, or just reducing costs dramatically. And one of the key costs is fraud and digital identity. So the more progress you can make on that, the cheaper you can reduce risk in the system and make more progress on some of these alternatives. But I personally think central banks will remain an essential part of it. So I think a lot of the payments are still going to be on central bank sanctioned currencies, but a lot more is going to continue to change.
I think I hear. Aaron, have you joined us?
Yeah, Matt, Hans, I'm like Beetlejuice. If you say real-time payments, I appear. Apparently, in this technology of fintech, we're still struggling with the Mac WebEx browser conundrum processes. But I'm pleased to be able to join, and I want to jump right in, kind of following that up, Hans, because you talked about real-time payments, which are not yet in the hands for America, even though most of the rest of the world is there. And in fact, COVID brought home the need for access to digital money. In the pandemic, millions of families were waiting months for their emergency check, which often arrived in the mail. Yet you've written that by 2040, we're going to be done with physical money. And Matt, you said that instead we're on these tokens. How do you get there when it's 2020 and people are waiting in months for a paper check?
Well, Aaron, we talked about it a little bit in advance of you joining, but I think let's skip to the second part of the question, which is first part we answered, which is solving identity, which I think Hans and I agree is a problem on its way to be solving, and then associating accounts with identities, and all of a sudden you've solved disbursement challenges largely. So
how
we have some shared confidence.
How are we? So in a country, one of my favorite statistics is 38%. That's the share of Americans who have federal photo identification in a passport. Otherwise, 62% of Americans have no federal photo identification. But we're going to figure that out through a voluntary identification system.
Well, I think, Aaron, that's actually been happening because almost any financial application requires authentication. I mean, it's impossible because it involves money and there's lots of crooks. So any software company, or whether it's regulated or not, if you're touching money, you have to authenticate the people. And I think that's where we see real progress getting made with or without access to a passport. And I think what I'd say is really powerful is you have companies. The example I like using is Propel, which enables over 5 million people on food stamps to use that app all the time to navigate the food stamp system. And they've now set up a debit card, particularly for capturing the child tax credit. And they are profitably servicing those customers. And those customers would be viewed as very unprofitable by most financial institutions. But they have to do authentication of every one of those customers too. So I think the cost of that authentication, I believe, is getting cheaper and will still get cheaper, even though fraud will continue to morph and change, and we'll get new technology to screw up authentication systems.
Matt, is there going to be a day when I don't have to, when I sign "help, this is fraud" for my credit card and they don't swipe it through, or I don't even have to sign? It kind of struck me as nuts that even during the pandemic, when we thought you could get COVID by touching things, you still had to write your name on a digital pad that no one ever checked.
Yeah, I do think biometrics, I mean, Apple and Google or Android, Google's Android are pushing this country and many other countries towards a comprehensive biometric database of identity out of convenience for the user. So I have high confidence that, again, because of user choice, because of the benefits and convenience afforded by substantiated identity, one element of which is not having to sign your name or touch a keypad, but other elements will be, ready access to public places or private concerts, or again, ease of onboarding into various applications. We're chipping away at the privacy phobia. There'll be a bitter group of sort of never me folks, but I think we're going to get to 90+%. And certainly the beneficiaries of federal disbursements will be highly incented to be, part of that wave of people willing to substantiate themselves. There's a crypto project where they've built these low-cost orbital scanners, and they've distributed them globally. And there's a cryptocurrency associated with this. And if you scan your eye and join this global biometric identity database, you get your share of that cryptocurrency. And Sam Altman, who founded Y Combinator, is behind it. Am I along that project? No, but the fact is, this feels inevitable. If you look at what's been done in India around biometric national databases, that's a government program. I'm not sure it'll be a government program here in our United States, but the course of history seems inevitable in this regard, that identity is going to be a largely solved problem in the next 20 years.
So if you guys are, you guys, Hans, you're in agreement with that?
I am in agreement that you are going to have more and more settlement alternatives, which will often be faster. And a lot of the risk currently lies in this authentication feature. And there's already good options, and they're getting better. So yes, I agree with that. But lots of ways to settle. I think that creates a bunch of other risks. having lots of ways to settle and how to optimize. And,
So let's talk about
real time.
So let's talk about one of those ways, which is a central bank digital currency. Today we all run on CBDC. Larry was talking about that when he started talking about how his MasterCard works, which is commercial bank digital currency. Do you think America should add a central bank digital currency to our existing commercial bank digital currency? If so, why? And if not, why not? Hence, what do you think?
Well, I guess I think that there are definitely some advantages. I guess I would be skeptical that giving everyone a bank account issued by some federal entity, which could be serviced cheaply because it's a central bank digital currency. I'm not sure you need to do that, and I actually think you're probably going to get better private sector alternatives, in terms of the actual interfaces that the consumer uses. So, but I remain open-minded about it. I'm actually very excited. I don't know when the report is going to come out, but I understand from reading Politico today that it's soon, like maybe a matter of weeks. And I think it's, so what do I think about central bank digital currencies? I think that they are likely to be, there will be manifestations of central bank digital currencies all around the world. So I truly believe that. What commercial disruption they cause really depends. I don't think the extreme cases are likely to happen because I think, to me, the providing the risk taking and the yield curve transformation, the other aspects of banking that you get from having multiple banks being an intermediary, I think that's a benefit from the banking system today. I think the settlement layer, which is a key, risk in the current payment system, could be, I think, enhanced a lot with adding a central bank digital currency as a settlement option. But I still don't think it's going to be, it's hard to say, but to me, it's not going to be as transformational as some of the other tech developments we've seen over the last 10 years and we expect to see in the next 10 years.
I would say, not only do I not think there will be one, but I hope there will not be one. I think that one of the paramount priorities of the Federal Reserve should be to keep our banks solvent. And the idea that you would create a separate system of account that would have at some level a cannibalizing effect on the retail bank relationships and maybe even commercial bank relationships of citizens and businesses seems just like a bad idea to me. And the negative impact on our banking industry far outweighs the potential efficiencies brought about by this kind of narrow banking structure. Further, it just seems like churlish to me that, the sort of talk track here is, well, Facebook talked about creating a currency, so we have to create a digital one. It doesn't seem in pursuit of any policy objective that I'm aware of. I think it can be done through the existing, as you say, CBDCs, which is to say the banking system and the associations formed by those banks in the form of MasterCard and Visa. So I don't think it's something that the United States Federal Reserve should busy itself with. I think there will be countries where, and obviously there are, China for sure, who have different styles of government where it may be more consistent with those styles of government, but I'd be surprised to see it here. You may have silenced Aaron.
It's wiped out by that comment.
I was floored, Matt, but I think you represent a very reasonable point of view. The only thing I'd add to what you said is don't forget that China's doing it. So if China's doing it, we have to too. It's not just Facebook jump-started it, no question, but I think China's dabbling in it is definitely a function. Let's move down the coin side or go to the flip side of the coin and stable coins. The President's Working Group on Financial Markets recently issued a report noting risk from stablecoin, calling for a new regulatory regime whereby only banks would be allowed to issue stable coins, and those banks and the digital wallets that hold them would be subject to regulation by the Federal Reserve. Is this a needed or good idea? And why should we regulate stablecoins differently from their analog comparison, money market mutual funds, a comment that Greg Baer made earlier? Matt, let's see, do you have two unconventional takes in a row?
I'm a fan of stablecoins. I think there is a valid policy consideration that stablecoins could weaken the power of the U.S. government by obviating the need for fiat currency in certain use cases. So I would readily acknowledge that. And if that policy objective is deemed to be essential, then I could imagine grounds for regulating stablecoins and for forcing that activity back into the banking system. But it will be bad for the economy. It'll be bad for creativity. We're seeing a Cambrian explosion of interesting projects in crypto, and the money movement within the crypto ecosystem is based largely on stablecoins, whether they're backed by dollars on a one-to-one basis or over collateralized by other forms of crypto, or so-called algorithmic stablecoins. And there is some consumer protection consideration involved here for sure. But it's a very small corner of the economy in terms of systemic risk. And I believe in these experiments and projects, and I think they should be allowed to exist. And I think bringing stablecoins back exclusively into the banking system will have a real curtailing effect on that experimentation. And so net, I would say that's a bad idea.
All right. Hans, what do you think?
I would say, well, I think the President's Working Group had a very pro-bank push to it. And I think I would actually agree with the PWG's comments about what the issues are. And I think whether it's market integrity, investor protection, governance, illicit finance, those are all very valid issues. And I think therefore it's appropriate that they be regulated. And I think given what Matt said is completely true, which is this is the liquidity process of a lot of the crypto ecosystem is through stable coins. So it's becoming a very prominent feature of an ecosystem that's big. And so in my view, it's inevitable that it will get regulated. So definitely gonna get regulated. How is it regulated? And the concerns that they raise are good concerns. Whether, how much leverage and how much oversight and whether they would need to be fully supervised institutions, that's probably, to me, overkill. And it's not extending to other places, like PayPal or other places where you're storing money. People are storing money, and there could be significant systemic risk from that type of, some disruption that took place there, something that people didn't expect. I also feel that we will have, at some point in the next 4 years, we're going to have some liquidity issue, which is suddenly going to change dramatically everyone's perception of risk. And if I was running a stablecoin company, I would say we want to be absolutely the best viewed and best operator and cleanest and the one that has, the best controls and processes. Because if you don't, you will not become the safe harbor in that environment. You'll have a run. And so that you want to do everything you can to protect yourself from that. So I would absolutely welcome regulation, maybe not exactly the way that the PWG report suggests.
So if you were running Tether and somebody put $1 million bounty on showing your book, you'd show it and collect $1 million because you'd be safe and secure?
Well, if I was Tether, there'd be lots of things I would do differently, I think, to be that safe harbor in a storm.
It's a very fair point you raise. There's over $1 billion stored in Starbucks app, which for many years was the #1 payments app in America, bigger than Apple Pay. Just kind of stunning when you think about that. I've wondered if under the PWG report, Starbucks would become a bank holding company if they simply move the Starbucks gift card to a blockchain. Let's continue with this idea on regulation. and kind of go a little bit bigger than just a stable coin, you know, how would you grade the current response of regulators to the fintech revolution? And how does current and future regulation impact your views of companies and markets as investors? What do you think?
So it's a big, juicy topic to talk about. And obviously, you know, and everyone in this conference knows that we have a unique system in the U.S. and we have 8 primary financial regulators at the federal level, and we have 50 state regulators, and you have FSOC and all kinds of other special organizations or committees. So it's very confusing. And I think that if you were to make a list of what are all the societal benefits, public benefits that we get from technology in financial services, and what has fintech brought, it's a long list, which includes lower fees, I think better alignment of interests with consumers, lower information costs, and reduction in barriers to inclusion, eliminating a lot of bad practices that the banking system had, better experiences for customers. Real-time data and reduced settlement risk can reduce systemic risk, and can more efficiently match credit and risk to cost. So those are just a few examples, but there's probably dozens more. But I think there are also equally valid concerns, and those include illicit use of the financial system and misleading or some sort of illicit use of data, or just greater risk of cyber attacks or other malicious activity, potentially to exacerbate financial inclusion or to increase bias in lending decisions, more fraud risk. So there's a long list of things that technology can also do that is bad. So the question for me in regulation is like, okay, well, who's responsible for each one of these and is executing that and providing clear guidance to participants in the ecosystem so that they're doing a good job and creating the good parts of impact the technology and not the bad parts. And that's what's very confusing right now, because you sometimes will have different regulators with different points of view, or sometimes it's just not clear at all who's responsible. And sometimes something will develop and move pretty far along before any regulator decides they've got the ball on it. And then you have examples like the SEC and CFTC where they're really competing to address some of the same issues. These are not new problems. It's just that when things are changing rapidly, they become bigger problems. And I think it inhibits the economic competitiveness of the United States. I'm obviously not the first person to say that, but it definitely is true. And if I compare it to the UK government or Singapore or China even, I would say where there's just much more clarity, at least in some ways. And it's even, Singapore and the UK both have said it is the policy of this government to make London and Singapore fintech capital, and to not say we aren't going to regulate, but to be effective in the regulation. So again, these are not new observations. I'd say there are times when, and there are certain regulators who've done a very good job, I think, and then the problem is, you'll have a change in a regulator, a change in administration, and you tend to go back to, not to square one, but it's hard to get to the same place. And so those are some of the observations I would have.
That sounds excellent. Before I turn to Matt, you said some people have done a good job. Who do you think? Name one or two that you think did a really good job. Give a shout out.
Well, I think the FDIC has done these tech sprints, which are, everyone else would call a hackathon, but if you're a regulator, you can't call it a hackathon. I think that I think Brian Brooks actually pushed, this may not be popular, but I think he pushed to get some things decided and got forced agreement. I actually thought, the Treasury report during the Trump administration, when they came out, I thought it did an excellent job of laying out some of the key regulatory issues, certain considerations. I thought it was a very good, fair and square. I mean, not every single thing was fair and square in there, but most of it was not political. So those are just a few examples.
That's fair. Matt, what's your take? How does regulation impact your view of companies and markets as an investor?
Well, let's just say, I mean, empirically, there has been an absolute explosion of fintech innovation here in the United States. There has been tens of billions of dollars of VC funding for US-based fintech companies. There are well over 100 million Americans who use one fintech app or more. There are hundreds of thousands, if not millions, of businesses who use fintech apps to help them get paid, pay their bills, run their businesses, borrow money. So I think we can look at the evidence of that, which is far beyond what I would have expected a decade ago, and say that at worst, the regulators have done no harm. And again, empirically, they've created an environment where the world has changed dramatically and for the better for consumers and businesses as it relates to accessing and using financial services. So I have to give the regulators a very good grade heretofore, and it could have gone a lot of different ways, and we don't dwell enough on how much worse it could have gone, because I think it's gone pretty darn well. Now, the methodology as I observe it, I don't think this is written down anywhere, but methodology of the regulators, and again, diverse patchwork of regulators, but seems to be that they know how to regulate financial institutions, and they don't know how to regulate technology companies. And so the method, therefore, is to force a regulated financial institution into every transaction. So if you're going to move money, there has to be a bank. If you're going to store money, there has to be a bank. If there's going to be securities transaction, there has to be a broker dealer, et cetera. And therefore, it's created this whole cottage industry of wholesale financial institutions, rent a charter, you might call them, or bin sponsor, or wholesale broker. You call them any one of a number of things, fronting carrier in insurance, that have created this enablement tier where they basically manage the regulatory compliance and let the fintech companies innovate and build and stay largely outside the scope of regulation. That's been the recipe that's worked, if we can agree that it has worked. And I think, again, the evidence suggests that it has. But it's a little cockamamie, right? I mean, it's a little kludgy. It's not necessarily what you would sort of design in an optimal way. It came about through, sort of exigencies and necessity, but I think it has so far enabled a ton of innovation and customer satisfaction and benefits for society. I think where it seems to be reaching a challenge right now is in crypto. And here I would say that, Chairman Gensler is the most sophisticated thinker on crypto that I could imagine. I mean, it is a gift to everyone in fintech and financial services and crypto that he is in the seat that he's in, given his level of sophistication. But right now, there's a lot of uncertainty, like a great deal of uncertainty, because we're in this window where a lot of things seem ambiguous and also sort of menacing. So, uncertain and menacing are a tough combination for industry participants. And so I'm hugely optimistic that we have the exact right person to focus on the priorities of consumer protection, fair markets, healthy markets, and at the same time, innovation. I just think we're all eager for more clarity. And I think when the framework's established, I think the U.S. can continue to be wildly competitive globally. We just need that. We need to get back in the race.
Well, let's dive into that with one more question on your view as an investor, and then if there are audience questions, put them in, and we'll try to get to the best one or two of them before we wrap. But when you look at a fintech, what are the 3 to 5 things most important for you to consider? And what's the single biggest red flag you see that say, I need to avoid this? Sometimes I wish that government would stop, or think tanks would stop promoting best practices and do the world a favor by promoting worst practices so we know what to avoid. Give me some pluses and some minuses when you look at a company from an investor standpoint against this backdrop in the regulatory space.
Go ahead, Matt.
Okay. I mean, I think Hans and I have something in common, which is that though we look incredibly young here, I'm sure, we've actually both lived through a few cycles. And so one of the things that I've observed in cycles is that companies who have, enormous balance sheet requirements end up really struggling. And we haven't had such a crisis in a dozen years, and it shows, in terms of the level of exuberance that a lot of folks in the funding community have for companies that need endless capital as far as the eye can see, and in capital in a way that tracks linearly with revenue. And I personally avoid those companies. I think that those companies are susceptible to regulation, even if not in the first instance. As soon as there is a crisis, the regulators get very interested in companies that have a balance sheet that might pose a contagion risk to the folks from whom they acquire or rent that balance sheet. And so I'm happy to kind of miss out on certain types of return that would be available to my competitors who love balance sheet companies, and I just sort of stay out of that fray.
Yeah, I'm a big believer in that issue too. And here's the way that we think about this, which is that you have in fintech, let's say, who knows how many there are, but at least 35,000, we think, fintech companies and lots of crypto companies. And some are software business, pure software businesses, and they have software margins, so like 90% plus margins, and they and so those you can particularly they're very sticky and become integral to some function. You can justify pretty high valuations of the companies because just the present value of the company is very high, and the risk associated with that present value is less. It's very different when you've got risk in generating the revenue. And what do I mean by that? You can have certain types of payments actually can cause risk and cause you have to pay a lot of amounts to complete a transaction, and you're taking a fair amount of operational risk in facilitating that payment. But mainly if you're lending money, or if you're insuring cars or insuring lives, or you're taking settlement risk or liquidity risk, you need capital because you got risk. And the capital is the only way you keep from going bankrupt when something happens, which it will inevitably. So that's not the same thing. So you can't look at that company, which needs capital support every dollar of revenue, the same way you look at a software company. And also the capital, it doesn't really scale. So if you have $100 million of revenue and you need $12 million of capital to support that, if you get to $1 billion of revenue, you need $120 million of capital to support that. And the key issue is your capital generation rate sufficient to fund the growth that you want to have as a company. You can't double your revenues if you only have, let's say, a 25% ROE, which is a really high ROE, but then you need more capital, so you have to dilute your shareholders. So it's a fundamentally different business model. And right now, when we're in a world where risk is off and no one's really paying a lot of attention to risk, risk is the biggest issue, and something that we, just like Matt, focus on. But you can feel lonely sometimes talking about that when no one else is paying that much attention to it.
Well, I have to assume there have been many moments in your investor career where you felt lonely, some of which you were later deeply vindicated, and others of which went wrong. In government, it seems to be a place. I remember doing an investment pool where we invested in one company known as Tesla and another known as Solyndra, and I never saw the Fox News story about the Tesla loan. And so we kind of held in government to a very different standard than I think venture capitalists do. And it's a better society in the venture capitalist standard. I think at least you have clearer metrics. We got a question from the audience. I want to return to some of the conversations we started at the beginning as we wrap, and it had to do with inclusion. And it's true that the FDIC survey shows that about 95% of American households have bank accounts, but that's at the household level. There are many more individuals who are unbanked. I have some research recently that shows that 70% of people with 70% of check cashing customers have bank accounts. And they're going to the check casher, I believe, for the time value of money, since the check cashed at the casher is immediately convertible to usable currency, whereas a check deposit at a bank, can take anywhere from. The person was asking the question about, given how much financial lack of inclusion there is in the current society, how do you make sure that your new kind of more advanced state is an inclusive one and not one in which those who already have access to great financial services have access to even greater financial services, and those that are struggling in this alternate world, the 8% of Americans who spend $350 a year or more on overdraft fees, those without bank accounts, those at check cashers, payday lenders, et cetera. How does how does your technological solution solve for this inclusion problem? Hans, do you want to take a first stab, and then Matt, you can bring us home?
I'd say we virtually never. It's rare, I'd say, that we see a proposal or spend time on a proposal that is necessarily saying we're gonna do a better job than Bank of America or Chase on mass affluent customers. Generally, I think most of those people are pretty well served, and so if you say half the households in the country have liquid assets, they don't have to worry too much about liquidity. They don't have to worry about emergency funds. They have lots of different ways to finance things. They're well advised throughout their capital structure. So we don't spend any time on those people. But every single day, I'd say, we get entrepreneurs come up with an idea to exactly address someone who is not well served. And I'd say, I bet, here's a bold statement. I think that, over limit fees are essentially going away, or they will go away pretty soon, because there's several companies in our portfolio. Bridget will fund your overdrafts for you. There's lots of products to help you avoid any overdraft fees. I mean, probably 50 companies I can think of that do that. And then earned wage access, I think that's a very powerful trend, because to me, it's without question the fairest way for someone to get access to emergency money. And in many cases, not all models are the same, but in some, it's completely free to the employee. And either the employer pays or you fund it. You make money through interchange, one of those two approaches. But I think so the question from the questioner was, well, are entrepreneurs and venture capitalists spending enough time focusing on those solutions? I'd say definitely. That's a big part. And what I said at the beginning, I think before you get on, is that one thing that is very clear about fintech is companies have figured out to solve some of these problems by reducing the cost so that they can do it profitably in a way that a bank just could not. That would be a major achievement of the past decade.
Yeah, I couldn't agree more. I'd say a couple things in a little bit of a feisty way. One is that, venture capitalists fund entrepreneurs who are doing disruptively better things for their customers. Now, we can get it wrong. We definitely get it wrong. We have our cylinders too. But what we don't do is fund entrepreneurs who will make life a little bit better for people whose life is already great. Not because we're of an eleemosynary bent, all of us, but because that's just not an interesting business. The whole mantra is can you make something 10 times better for the customer? And that inevitably involves an underserved customer. That doesn't always mean underbanked or, one socioeconomic group, but it does mean underserved. That's all we care about, just in the profit motive sense. And so a dramatic disproportionate energy in the United States, where life for the mass affluent and above is actually perfectly fine, is spent solving problems that serve the middle of our economy and down, whether they be lending problems or payments problems or insurance problems. And I think, the fact is, in 2020, the dollar amount of fees that went to banks for overdraft went down for the first time in decades. And part of that is because people were spending less money because of COVID, but part of it is companies like Bridget and the earned wage access dynamic, which are fintech solutions that are shining a spotlight on bank practices and obviating the need for many Americans to have to overspend to get access to those funds. So I actually think what I've found is that the underbanked and unbanked are actually quite sophisticated. And there's an element of condescension that enters into this dialogue when we talk about, serving them. I think my direct experience is that population on average is using technology more and more and solving their own problems in ways that is going to chase overdraft off the economic playing field in favor of fintech solutions developed by non-banks and fintech solutions developed by banks out of competitive necessity.
Well, Matt, that's an optimistic and positive note to end on. I hope that that becomes very true. And I'd like to thank you and Hans for your time. And Julupa, I'd like to turn it back over to somebody who can put a face to a voice and close everything out.
Thank you so much. That was a great discussion. Sorry, Aaron, that we couldn't see you